So Robert, take over, and he's going to talk about retiring early through financial freedom because he's already done it, and he's going to share with us. So Robert, go ahead.
All right, thank you. Give me 1 second to share the screen. All right. Okay. And sorry, 1 second. I need to see my presenter view. Give me 1 second. All right.
Yeah, and Robert is kind of going to do presentation, but if you have any question, you can ask. The plan is to finish it in 1 hour, right, Robert?
Yes.
Yeah, and there's no end time. So if somebody wants to hang out, means I have nothing to do tomorrow, and Robert is already retired.
Right. Yes.
So we'll sit here as long as you want to talk, but the main crux of the presentation will be done in an hour or so. Okay, unless anybody asks a question and it kind of drags the presentation longer, then it's a different story. But otherwise, we should be done in an hour. So go ahead, Robert. Sorry.
All righty. Thank you, Rakesh. So, so first of all, the big red preface, you should know this is for educational purpose only. Uh, you really should consult an actual professional advisor before you make a major financial decision. It's good to learn, but also you should get some advice from the real people. So, why am I doing this presentation? This is not to sell any product. I'm not recommending specific brokerage or an advisor. I'm not recommending a specific stock. If you came to see that, that's not what you're going to get. Um, I'm basically sharing my investment experience backed up by experts like Warren Buffett and other people. I wished somebody had taught me what we are going to talk today about 10 or 15 years before I actually started investing. I started investing when I was 38 years old, or 37, I think. Years in my travels in retirement. So I'm just going to share you why getting this financial independence early enough matters, so that you can do travels as you like. I also want to emphasize that uh, I'm not trying to boast what I have done financially, but I will take the credit for all the pictures you see because those are the pictures I took. Uh, and I definitely don't know everything there is to know about investing. In part, I got lucky with my Amazon purchase back in 1997 because a nice coworker pointed me to something called Motley Fool publication. They're still there. I haven't used them in the last 25 years. And this was in 1997. In part, I got lucky with working at Fidelity and the patience, the consistent saving that they teach us, they give it to us some money. It was very good. So those are the two factors that helped me get going on my path. And as much as mine was an accidental success, I'm really hoping that other people can learn this in a systematic way. And there is a systematic way to do these things. Uh, and don't just hear from me, but rather from experts in the field. You might have heard about this guy named Benjamin Graham or Warren Buffett or Charlie Munger and so on. I'm mostly familiar with the US investors. Um, I highly recommend everyone to read the book Intelligent Investor. I myself haven't read it, but it's on my list to do. Uh, and I apologize if some of this matter is rudimentary. We are trying to cover everyone. So, with that said, so what you're saying here is first to introduce myself. I have an IT background going back 40 years. Uh, I personally started investing in 1997. So I started working at 21 97. So that was a good 15, 16 years, I did nothing about investment, right? 11, I worked 11 years at Fidelity. We pretty much lived frugally, and younger years, I recommend that to the youngster as well, and invest steadily. Um, Without tallying the actual numbers, the only reason I am even adding this third bullet is to emphasize that without knowing too much about investing, but just following some of the stuff that Warren Buffett and other people says, you could do amazing. And a lot of people are afraid that they don't know how to do these things. That's the misconception I'm trying to break here. Uh, so the one key advice in investment is that in investment, temperament is more important than your IQ in investing. A lot of people think you have to be smart as Warren Buffett to be successful. It's not the case. The market, and the market, when I say market, we'll see a little video here, is moves the money from impatient people to patient people. This has been throughout the history of stock market, and you will see some explanations going forward. I hope everyone gets something out of these things, but I particularly hope that you share this with your children in 20s and 30s because they are the one who can do a lot of the stuff that this thing is talking about. By the way, feel free to ask me questions. I wanted to add something that I completely forgot. I want to thank Rakesh for giving me this platform. Um, and w- the block here, the black square you see here is a quote from Charlie Munger. He was the right hand man for Warren Buffett. He passed away a couple of years ago. That the best thing a human being can do is to help another human being know more. Rakesh is already doing that for us, right? With these travel groups we have so much interest. I personally learned so much from it. So all of these things are uh, in a way to giving back to the community. And this particular presentation is in a similar way. Um, I highlighted those two lines about investment temper and market moving money from impatient to patient is actually the essence of investing. Um, to give you a little background, my investment journey started in 1997, where this gentleman called Srinivasan, working at company with me in 97, at lunch break came by and said, "Hey, Robert, do you know about this Motley Fools?" And I had no idea. So I read their magazine, and he and I would chat. And basically, at that time, Motley Fools were telling people, go buy Amazon. This was 97, where they were so new, right? They were telling, go buy NVIDIA. Now, I, I'm not trying to brag, but I got really successful with Amazon shares. I bought it back in 97, never sold them, and it has done amazing, right? On the flip side, I was doing day trading when I didn't had a job at one time, and I had NVIDIA shares that cost me no more than $10,000 at the time. If I had kept it and done nothing with them, it would be worth $23 million today. So this tells you that if you find the right company, not easy thing to do, but if you do find the right company, the right thing to do is to stick with it for as long as you can. Matter of fact, Warren Buffett always talks about this. He never buys these companies to sell. He buys these companies to keep it forever, right? And that's the idea. Um, I personally experimented with like before dot-com bust, five, six companies. Amazon was one of them. That one did great. Another one did okay. And the other three went bust. So I lost probably $60,000 in those three companies, right? But I held on to Amazon. I never bought another stock after that. And that's actually part of the video we will see. Um, I let Fidelity manage my portfolio since 2008, and it's part of the benefit we get when you work for that company. So let's jump into this. Uh, with that introduction, I am sure people are ready to say, hey, how can I double my money, right? Or how do I get rich very quickly? Or, send me 100K each and I will give you guys 25% return and you'll be happy, right? None of that is true because this is not the class for that. That's not the way you actually build a proper finance success. Let's take a look at this video quickly.
Buffett, why don't more people copy your investment strategy? It's not that difficult to understand in principle. And he said, oh, Jeff, that's easy. My approach is a get rich slowly scheme. People don't like those. And so, but there's a lot of truth in that for everything, which is if you can think in terms of
Okay, so he goes on for long. We are not into that. But you see, the bottom line is that this is a long-term approach to building your financial security. Okay, this is not something you want to do quickly. All right. So, what are the phases of building wealth? There are three stages. The first one is to earn money. That's an action, right? You went to school, you're going to job, you're earning money. The second phase is spending money. It's kind of learned behavior. Some people easily spend money. Some people will keep it in the house, right? They don't splurge easily. The third one is growing the money. It requires a discipline and a knowledge. So we are focusing in this particular session only about number three. The other two, I hope you know and you know how to do it well. Uh, we had in our group Tushar. He shared his summary of these two amazing books. There is a book called The Psychology of Money and The Art of Spending Money. I highly recommend. We have a link at the end of these documents that will show you his summary. Um, these books will help you understand the value of money and how to use it properly. Like if you splurge on physical things or you splurge on experiences, things of that nature, right? So that would cover number two, but we are not going into that right now. So the bottom line is that if you do not control your spending, then you do not have money left over to invest. You might as well stop participating in this class and go get your sleep because the rest of this thing I'm going to say will not help you if you can't do that red bullet. You have to get that under control. All right. Next. So this is a quote from Warren Buffett that almost everyone can make money, which is true. Uh, some can keep it, which is also true. Now, as far as a lot of us immigrants, Indian people I know, they know how to do earning money very well. They also know how to keep it. A lot of there are people who spend it too, but most of the people will keep it. But I have rarely seen people who very successfully grow it. Now, I have talked to many of my friends, and they are successful in growing it, but not by particular system or discipline. Sometimes you get lucky, like I got lucky with my Amazon, right? Sometimes you get lucky, but there is a system to this, and we learn this from uh, Warren Buffett and other leaders like that. So let's talk about how we're going to learn how to grow the money. Now, Warren Buffett also said this that if you don't find a way to make money while you're asleep, you will work until you die. And that is true unless you win a lottery or something, right? But the corollary to that for us travelers is also true that if you can figure out a way to make money without having you tethered to a job that requires your time, then you can travel. So if you figure a way to make money, then you are free to travel, right? So Money gives you the freedom to travel and do other things, not when you're not restrained by the job. Okay. So I added this next slide. Actually, before we go into the next slide, um, give me 1 second here. This thing is bothering me. So I added this slide because at the last minute, because I realized a lot of the things listed here is what people do wrong. And a lot of people have been burnt a lot by trying to make money in stock market. Let's just go through a couple of them. First one is people want to do it quick. You saw Warren Buffett said that in the first video. People buy stocks when they know nothing about the company. And what I mean by that, that you hear some news about a company, right? That's not understanding their business. People speculate based on rumor. Whatever happened last week, whatever happened in the last quarterly report, people will speculate. People invest in a stock or a company for less than 10 years. There are a couple of very prominent people that have said if you are buying a stock, you are buying a partnership in a company, you're owning part of that company. Now, would you do that if you're going to turn around and sell in a 6 month or a year? That doesn't make sense, right? You should be ready to buy it for 10 years, 20 years. You should, and that actually changes your perspective because when you think like that, all of a sudden you have to put more thought into what company you are buying. It's not something quick you're going to do and get rid of it, right? Because then you're speculating, then you're just gambling if you're doing that. So that's one of the thing. The other thing is people are trying to time the market. Up 10 times, people think that they can time the market. Honestly, Warren Buffett himself has said, I don't have a crystal ball. I never know what the stock market is going to do, and neither should you. And you cannot plan on that. Uh, People panic in the bear market. How many times we have seen that? I'll give you some examples as we go forward. FOMO in a bull market, it's a fear of missing out, right? You see the market run up. You see the Apple stock going up like crazy day after day after day. You got to jump in right now. That's FOMO. People fall for Ponzi scheme. Now, have you guys, I'm pretty sure a lot of people have heard about Ponzi. I know Rakesh had introduced us to the details of that in our one of our Reels group. Let me give you 2 seconds to explain because people do fall for this. There was a guy, gentleman, I wouldn't say gentleman, there was a guy named Charles Ponzi in Boston, and this was in 1920s. He convinced, and this is a problematic what happens. Apparently, there was a stamps you could buy in US mail stamp, back then 1920s, just a regular mail stamp. And you can buy the stamps in Europe. Apparently, the stamp price in Europe was like one-fourth the price you would get in USA. So his scheme was, say, he would buy the stamps in Europe, he would cash it into the US and cash the extra money difference, right? Well, on the paper, that sounds great, doesn't it? And he convinced a lot of people. He convinced lawyers, he convinced judges, he convinced policemen, he convinced politicians, average people. And what he did is he would collect the money from these people and he would pay, he promised them 45%, 50% return in 45 days. That's what he promised. So he did that. And obviously, it wasn't practical. Somebody did a research. There is not enough post stamps in the world to pay all the people he was collecting money from. So you will see in your life variety of these schemes where people promise you 10%, 15, 25% guaranteed returns. These are not all are Ponzi schemes, but majority of them are. That's how you lose money. You don't have a patient or a mental attitude. When the stock is going down, you have to be willing to withstand that, right? So this is another 10-minute video, but this is very important. I'm trying to cover it early in the presentation. because it's a very important video. So I'm going to fire it away and let you guys see that.
The Intelligent Investor is the best book on investing ever written. And he literally said reading this book at 19 changed his whole life. When I read it, it kind of changed how I see money forever too. Because this book doesn't teach you how to predict the market. It won't sell you some secret formula to get rich overnight. What it really teaches is how to think about money, investing, and risk.
I'm sorry to interrupt that. This book he's talking about was written by Benjamin Graham in 1949. He was a professor at Columbia Business School, and he was also an economist. He wrote this book, and this is the best book Warren Buffett says he has ever read. He went and studied under this guy, and the principles that is taught are universally applicable. Warren Buffett have used this and materialized it. Other people can do it too. But see through this video because those are the principles you want to learn from this class.
Risk in a way that keeps you safe and helps you actually build wealth long term. And today I'm breaking down the 5 biggest takeaways from it, the ones that will save you from a lot of pain, help you avoid dumb mistakes, and finally show you what it really means to invest intelligently. Takeaway number 1, Mr. Market. Let's kick this off with probably my favorite idea in the whole book, and it's the one most people screw up the worst. Imagine you own a small local coffee shop. Nothing fancy, but it makes good money. Regular customers, steady profits. You love it. Now, every single morning, this weird neighbor, let's call him Mr. Market, comes rushing in with a wild new offer to buy your coffee shop. Day 1. He storms in. I'll give you $1 million for this place. Coffee shops are hot right now. You're thinking, sounds insane, but noted. Next morning, Mr. Market drags himself in looking miserable. Coffee's dead, man. I'll give you $50,000 tops. You should sell before it's too late. Day after that, he's back. Good news, $700,000. I changed my mind again. Coffee's cool now, and this goes on every single day. Now here's the key question. Would you take him seriously? Of course not. You'd laugh. You'd roll your eyes. You'd say, bro, come back when you're sober. But
So just to make it clear, as I said earlier, owning a stock is like owning a company, right? So what this guy is telling here is that as if you own this coffee shop, part ownership of coffee shop, are you going to sell as the market mood changes?
when it comes to the stock market, people listen to Mr. Market like he's some kind of financial wizard. Stocks go up, everyone's suddenly a genius. Stocks go down, everyone's crying and selling. Why? Because the market looks official. It's on screens, it's on the news, it feels serious. Graham's point is, Mr. Market's behavior is no more rational than your crazy friends. He's emotional, he's dramatic, he's obsessed with fear and greed, and most of the time, he's wrong. You don't have to sell your coffee shop just because he's feeling moody today. Same with stocks. So what's the smart move? Use Mr. Market's mood swings to your advantage. When everyone else is panicking, prices drop. That's when opportunities show up. When everyone's greedy and throwing money at stocks like it's free candy, maybe it's time to chill and not overpay. Think about this. During the 2020 crash, great companies like Microsoft, Apple, and Amazon got way cheaper. Not because they suddenly became bad businesses, but because Mr. Market was having a meltdown. The people who understood this principle didn't panic. They saw an opportunity. This is what Graham means when he says, the market is there to serve you, not to instruct you. Your job isn't to predict where prices go next week. Your job is to understand the value of what you own and act only when it makes sense. That's how you win long term. Not by trying to time every move, but by knowing when to sit tight and when to take advantage. Takeaway number 2, stop speculating. All right, let's clear this up. Investing is not the same as speculating. Let me explain. Investing is calm, thoughtful, long term. It's like buying a house you actually plan to live in, raise a family in, build memories. You check the neighborhood, the plumbing, the schools. You don't just buy it because the price might go up next week. Speculating, though, that's like buying the house just because your barber said prices are going to the moon. No idea what it's worth, no clue who lives next door. You're just hoping someone else will pay more than you did. And that's the danger Graham warns us about. See, investing means 3 things. You do your homework, you protect your money, and you expect a reasonable return. Not 10x overnight. The problem is, most people think they're investing when they're really just speculating. They chase hot stocks, meme stocks, headlines. They're buying because someone on YouTube or TikTok said so, not because they actually understand the business. Let me ask you something. If I offered you a tiny piece of a pizza shop you've never seen, don't know the owner, no clue if it even sells pizza, would you buy it just because I said it's going to blow up? No way, right? But people do that with stocks every single day. Here's a famous example. In the dot-com bubble of the late 90s, people were throwing money at anything with .com at the end. Didn't matter if the company had zero revenue. Didn't matter if they sold nothing but dreams. Prices skyrocketed and then everything crashed. Why? Because people weren't investing. They were speculating, hoping to get rich quick off hype, not value. Graham's golden rule is treat a stock like a part ownership in a real business, because that's literally what it is. You're not buying a ticker symbol or a lottery ticket. You're buying a piece of a real company with employees, products, revenue, good months, bad months, just like any normal business. And if you wouldn't buy the whole business, why buy a tiny piece of it? That's the mindset shift. This doesn't mean you can't ever take risks, but if you do, you better know why you're doing it, what it's worth, and what your downside is if things don't go your way. Investing is boring at times, sure, but boring builds wealth. Speculation just builds screenshots of your account right before it crashes. If you treat stocks like businesses, not scratch cards, you're already way ahead of most people. By the way, if you're loving this so far and getting some good ideas out of it, do me a quick favor. Hit that like button. Maybe even subscribe if you want to see more videos like this. All right, back to business. Takeaway number 3, margin of safety. Let's make this super clear, because honestly, this is one of the smartest things Benjamin Graham ever taught, and yet, almost nobody talks about it properly. Here's the big idea. Don't pay full price for anything, especially not stocks, because no matter how smart you are, no matter how well you research, things can go wrong. The economy can flip, a company can mess up, the market can panic for no reason. You need a cushion, you need room for error. Think of it like this. If you're building a bridge and the trucks crossing it weigh 10,000 pounds, do you build the bridge to handle exactly 10,000 pounds? Of course not. You build it for 30,000, just in case. That extra strength is your safety margin. Same with stocks. Let's say you figure out a company is worth $50 per share, but are you buying it at 50? No, not even at 45. You wait until it's at $30 or less. That gap protects you. It gives you breathing room if something goes wrong. Look at 2008. During the financial crisis, people were dumping stocks left and right. Solid companies like Johnson & Johnson, Coca-Cola, and others were trading way below their real worth just because people were scared. That's when guys like Warren Buffett were buying like crazy. Why? Huge margin of safety. He wasn't guessing. He was grabbing value on sale. And here's something people always ask. But what if I love a company and the price just keeps going up? Great question, and it happens all the time. Let's say you love Apple. You've done your homework. You believe in it long term. But the stock keeps running higher and higher. It's tempting to just jump in because FOMO, right? Don't. A great business at the wrong price is still a bad deal. If it's too expensive right now, you don't chase. You stay patient. Put it on your...
Sorry, one more thing I want to just quickly add here. He talked about 2008 correction. There is on HBO a movie called Too Big to Fail. I urge you guys to all interested in investing to go see that movie. When you see that movie, you would realize how close this country came to total economic collapse. And it can happen again. And they do, yeah, they fixed it properly last time. Who knows what will happen next time? But this is something one has to be aware when you play in stock market. Things beyond your control.
Your watch list. Follow the business, not just the price. Wait for Mr. Market to throw one of his classic mood swings again. And trust me, he will. That's when you strike. Warren Buffett once said, "The stock market is designed to transfer money from the impatient to the patient." Your edge isn't just knowing what to buy, it's knowing when to buy. You wait for that price where you've got room for error, where the risk is low, and the upside is solid. Takeaway number 4, pick a side. This next idea from Benjamin Graham is super important because it saves you from years of confusion and frustration. It's this. You're either a defensive investor or an enterprising investor. There's no middle ground. Let me explain this in the simplest way possible. Imagine 2 types of people at a gym. One shows up casually, jogs a little, lifts a few light weights, feels healthy, goes home. They're not trying to compete in bodybuilding. They just want to stay fit and not injure themselves. That's your defensive investor. The other person? They've got a plan, a coach, a meal prep routine, supplements. They track every workout. They want results, they want gains, and they're putting in serious time. That's your enterprising investor. Both are fine. Both are smart as long as you know which one you are. If you're defensive, here's what that looks like. You don't chase stocks. You don't time the market. You don't treat CNBC like breaking news. You buy broad, boring, beautiful index funds like the S&P 500. Maybe sprinkle in bonds depending on your age. You invest consistently every month, whether the market's up, down, or sideways. That's dollar cost averaging. You check your portfolio once a year, rebalance if needed, and then you let compounding do its magic. This is how most people win long term. But
So, one quick point here. I think this is the most important thing, whether you are a defensive or a stock picker. A lot of people I talk to wants to get rich quick, so they will go for stock picker. And that's where they fail because they don't have the expertise like Warren Buffett to properly read the balance sheet, the financial statements to correctly judge the company. They're only going by what they hear in the news. By the way, when you hear the news, it's too late. Whether the thing is crashing or whether the thing is flying up high, sky high, you are too late by the time you hear the news to react. So young people who want to get into the investing, your best bet is not to go in stocks. Your best bet is to go defensive, but you must start investing in your early age.
if you're wired differently, if you love digging into businesses, reading financial statements for fun, hunting for undervalued stocks like a financial detective, then cool, go enterprising. That's what Warren Buffett used to do when he was younger. But know this, it's work, serious work, and it's not for most people. Graham was super clear on this. If you don't have the time, skill, or interest to research properly, be defensive. If you're obsessed, disciplined, and willing to outwork everyone else, go for enterprising. But don't try to play in the middle. That's where people get wrecked. They end up chasing trends, buying high, selling low, panicking when things drop. That's how people lose money and confidence.
Right? We just talked about that one in the first slide that because you try to do that stock game without the expertise behind it, you end up losing money. And not only money, you're losing time too. We'll see that soon.
Takeaway number 5, emotional discipline. Let's talk about the part no one wants to admit. Your emotions are probably your biggest enemy when it comes to investing. Benjamin Graham was very, very clear about this. He said the difference between successful investors and broke ones isn't intelligence, it's emotional discipline. We've all seen this happen, right? The market drops 5% and suddenly everyone's acting like it's the end of the world. People start panic selling. Oh no, my stocks are down. Buddy, they were up 40% last year. Chill. Or the opposite. Some random stock explodes overnight. Everyone's making memes, flexing screenshots on Twitter. What happens? Greed kicks in. FOMO takes over. You think maybe I should YOLO into this too. Look at history. Markets crash, rebound, crash again. Take the dot-com bubble in 1999, or 2008 financial crisis, or 2020. Some people panicked, sold everything. Some stayed chill, kept buying great businesses, ignored the noise. Guess who came out richer a year later? It's not about predicting the future. It's about keeping your head when everyone else is losing theirs. Because here's the truth. Markets will go up, markets will go down. Sometimes for reasons that make no sense at all. Your job isn't to control the market. Your job is to control yourself. And how do you do that? Have a system. Dollar cost average. Rebalance. Stick to your plan. When you've got rules, you don't need to make decisions based on panic or hype. Think of it like flying a plane through turbulence. The pilot doesn't start yanking the wheel because of a little shake. They follow the system. Same with investing. All right, let's wrap this up in a way that actually helps you when you go back to your money. Think of these 5 takeaways like parts of a puzzle. They work best together, not alone. First, you gotta treat stocks like owning a real business, not some magic ticket to fast money. Every time you think about buying something, ask, would I be happy owning this for 10 years, even if the price didn't move tomorrow? If not, skip it. Simple. Then, you protect yourself with the margin of safety. Don't chase stocks when they're running hot. Be patient. Wait for the price to give you a cushion, not a heart attack. This saves you from costly mistakes. Next, when Mr. Market throws a tantrum, you don't join the drama. Let others panic. You stay calm. Sometimes the best move is doing nothing. Then figure out who you are. If you don't want to babysit stocks, stick to index funds. If you love digging deep, go for it. Just commit. Don't float somewhere in the middle wasting time. Finally, master your emotions. This is the glue that holds everything together. Without discipline, none of this matters. Build habits that make it automatic. Dollar cost averaging, rebalancing, and ignoring the noise. If you use these together, they protect you from yourself, from hype, and from market madness. That's how this becomes practical. And hey, this book is a monster. What we just covered, that's barely scratching the surface. There's so much more inside.
All right. So I wanted to take like 10, 11 minutes of this video because as you can see, It is very important. It is the essence of a successful investing. And we went through this, the reason people fail. Uh, Power of long-term investing and compounding. So you remember how we plan, we go through this is travel group mostly, so that's why I'm bringing this up, that we take time and we put effort over time, months to plan this fantastic trip. The compounded dividends are like that. It takes time to build up, but when you get there, the results are amazing. Same thing with the compounding. So, what is a compounding? And this is very fundamental. I'm sorry, some people already know this. Let's say you have $100, you invest at 5% interest. At the end of the month, you got $105. Perfect. Now, the $105 gets invested, same 5% interest. A month later, it becomes 110 and 25 cents. That 25 cents is the compounding, right? Because that extra $5 got reinvested and it earned another 5% interest. Imagine you are replicating this on a grander scale for $100,000, $50,000, whatever, right? It works that way. Time is your friend. Time, people underestimate what my investing journey only started in 97, but I would say so in what, 20, 25, 26 years, it has done amazing for me. And that's mostly because of compounding. Uh, Everyone wants to get rich quick, and that's why you make mistake. That's where you fall down. You don't have to be smart as Warren Buffett, and anyone can do it. This is another mistake a lot of people make, younger people particularly. They look at this financial whiz and they're like, well, I can't do that, right? That's very hard. I don't know how to read the financial statements. I don't know how to do that. The truth is, yes, you don't know those things, but you do know other aspects of reading the company, reading the temperature. To give you an example, I was in IT industry in 90s. I knew when Amazon was gearing up that that was something useful. I saw it with my children buying online. I experienced myself. So that gave me assurance that, okay, stick around with this company. You don't need to panic and sell this company. Same thing. If you can judge it based on your personal experiences, not what you heard on news, but on your personal experiences, that's a good way to judge a company, whether you want to keep it or not keep it. Uh, let's take these two examples. I have shared with some of my friends already. This first, and this is to show you an example of compounding. The woman starts investing it at age 25, and she puts $5,000 for 10 years. She stops investing at 35 completely. The next person starts investing at age 35. He puts $5,000 every year until 65. So he puts for 30 years. Okay. You would think the second guy would have more money, but no. The woman would have $787,000 versus he would have only 611. That is not to count that he put extra $100,000 to begin with, right? Now, this is a hypothetical example, but the mathematics behind is correct. This is exactly how the compounding works. Here's another example. This is a little bigger one, that the woman on the left starts investing at 25, the woman on the right investing at age 30. They're both putting the same amount of money. At the age 65 or 67, I can't see behind my screen, the difference is $500,000. Only 5 years of difference. Let that sink in. The second person started 5 years later. The first person started 5 years earlier. So, what is the lesson for people in here? What this illustrates is that when you are young, right, when you are in your 20s, that 5 year was difference of what, $6,000, $30,000, right? That $30,000, you could be eyeing that shiny new car, right? Today it's like $60,000. But that car is costing you $500,000 35 years from now, right? That's what should be the message out of this chart. that yes, compounding works greatly, but compounding costs you if you are not careful with your spending in your younger years, right? So hold that gratification. It's all about the gratification. Uh, there are different types of investment. I think this is fundamental, so I'm not going to go deeply. We will provide you this slide so you can definitely go look at it. The examples I gave here on the number 5 bullet, the index funds, they are useful. Definitely go take a look at that later on. Uh, ETF versus stock. This is pretty self-explanatory, right? The stock is individual company, ETF is like a fund but low cost. The risk is low in ETF. Risk is high on because it's concentrated in one particular company. Rewards are average for ETF, just like mutual fund. Rewards in stocks are incredibly high if you hit the right one, like Nvidia or Amazon. Research on your part, very little required if you do ETF. Again, remember that Benjamin Graham thing. You are a defensive investor if you're doing ETF. You don't need to do too much research. Just need to play in the market. Stock, you need to do the proper research, otherwise you can get hurt really badly. Fees, very low fees in index funds, none in stock, obviously. Good for long-term investors. Stock is good for long-term investor as well, because if you're buying a stock, you really should be buying for long term. But you do need it is more geared for more active investors like Warren Buffett. Um, Rental properties. So actually, let's look at this. Just like in travel, not one solution fits everyone, right? Sometimes you want to go to a fancy trip. Sometimes you just want to go to the local lake or a river trip, right? And you're happy. Same way in investment, you have cash, you have real estate. The real estate is a good one, particularly if you're in the middle of your career. It would be a good idea to have some side properties to generate income in your retirement. It's a steady income. And for us travel oriented people, this is great for me because money keeps coming even while I'm traveling. I'm not tied down to it, right? Now, it's not for everybody, but you get the idea. Not everybody wants to deal with tenants and all that stuff, right? You have stocks and bonds, you have international funds, you have metals, gold and silver, and all kind of stuff. Um, Dollar cost averaging, you heard a couple of times. This is also pretty fundamental, but I should go through it. It's a method of investing by discipline. You invest fixed amount every month, no matter what going on in the market. Many young people don't know where to begin in investing. All I will suggest to you guys, start putting dollar cost averaging in your 401k, in your other retirement account, whatever it is. Just set it up and forget. Okay. Let's give you an example. Say today the Amazon share is $250. You decide to put $250 every year. This is a very simple example. Okay. So year one, the price is 100 a share for Amazon. So you bought 2.5 shares, right? Year two, the price dropped. So it's 50 a share. So now you're buying 5 shares. Remember, you're always putting $250 in that company. The third year, Amazon share jumps back up to 250. So now you can only buy 1 share. So over 3 years, you ended up buying 8.5 shares. That cost you $2,125. But at 250 a share, that 8.5 share is worth 700 and it cost you $750, but the value is $225, right? This is dollar cost averaging. And it has some benefits. Uh, it avoids a poor market timing. You're not trying to time the market. When Amazon goes up, I will sell. When Amazon goes down, I will buy. Nobody can predict. You will not be able to do that. It takes out the emotions of investing. You're buying more shares at a discount, particularly. So think of this way. We we all talk about dollar cost averaging. We all talk about buying on a dip. But on a dip, why would you do that? Unless you have a full trust in that company, right? If you had done your research up front that yes, Amazon is what I want to buy, that I believe in it long term, then and then when there is a dip, you plunge your money because It's like it's on sale, right? That stock is going on sale. Warren Buffett always talks about it that he actually likes all the company he buys to go down because he has done his research. He knows what these companies are. He wants them to be on sale, just like we want our stuff on sale in the supermarket, right? Um, there are some risks also. In a bull market, you would do less better than active trading, right? Um, Market corrections are way of life. If you get into investing, don't think that it will always go up. This is a very important poem. I have listed the whole poem at the end. I'm just talking the lines that are highlighted were picked by Warren Buffett. If you can keep your head when all about you are losing theirs. If you wait and not be tired by waiting. If you think and not make thoughts your aim. If you can trust yourself when all men doubt you. Yours is the earth and everything that is in it. It's a very philosophical poem. He wrote it for his son, actually. It's a very long poem. Uh, to give you an example of when everyone is losing your head around you, I was working at Oracle, and like normal, and in a lunchroom break, we would talk. And if you remember March 13, 12, I forgot the date, 2020, where the COVID blew up on us, right? So one Indian gentleman, he was working in sales, so I didn't know his name. I didn't know him well. He was so upset, and we were just chatting, and it's like, my kid's education is in this market, right? He was panicking so bad. And I tried to explain to him that, look, on one hand, if we are all dying because of COVID, what does it matter what's happening to your money? Because we'll all be dead. On the other hand, if you think bigger picture, it's a science problem. COVID was a science problem, medical problem. I at least believed they would fix it somehow or they would mitigate it. And ultimately, that will fix the market. The higher risk was 2008. And again, if you see that movie, you will realize why I'm saying that. The 2008 was actually more serious harm to economy and the stock market. But we survived that. Matter of fact, if you look at the history of America, the stock market has never gone down in a long term. It always goes up, just like real estate. It always goes up. It would have correction. Corrections are way of life. And that's why timing the market, by the way, I don't know what happened with that gentleman. I hope he didn't sell anything because you all know the history. The market recovered amazingly right after that. Timing the market rarely works. You have to get it right twice, right? When you're going to buy it and when you're going to sell it. No one has a crystal ball. Uh, all right. This one is also important. The key cost of being on sideline. There are a lot of people talk that, oh, wait, I will buy when the correction happens, right? They're waiting on the sideline. Uh, some of the market's strongest daily gains often occur right after the high volatility and after the steep declines. Missing even few of these top performing days can drastically cut your returns. Analysis was done, and I'll show you a diagram. Analysis was done on 10,000 investment in S&P 500 index, nothing else, okay? Not even a specific stock. From 2003 to 2022, almost 20 years. An investor who missed the 10 best days cut their return in half. Okay, an investor who missed the 30 best days could actually end up being in negative, in red. So the bottom line message is you must stay invested. Let's look at this diagram. I don't know, I'm going to try to enlarge. So what this is showing you is if you invested $10,000 and stayed it all 20 years, it would be worth $64,000, 65 almost, okay? But if you miss the 10 best days, that's pointed by here, and we can enlarge it a little bit. Yeah, we can enlarge it. Oops, and this is what I was afraid of. So if you just miss the 10 best days, the return cuts in half. If you miss the 30 best days, you're breaking even. And then 40 days, you're in the red, right? So now where I wish I can I can enlarge this for you guys, but you can look at this slide at your convenience. These are the numbers in 2008. Some of the numbers are in 2008's 11% run in one day. Okay, it's a 1 day run. The dates are there too. Like there were like 7 or 8 runs in 2008. So anybody who panicked in that correction and took the money out, they missed out on the biggest run of the market. So this is the cost of trying to time the market or trying to stay on the sidelines. You would pay big time. And guess what? If you try to do this over 20 years and you miss just the 10 or 30 days, your returns are half. So all these fancy numbers you see when people say, "Oh, you invested $10,000 S&P 500, it would be worth $65,000 now." That assumes you stayed invested. You didn't panic. You didn't try to time the market. You didn't try to adjust it. That's what the bottom line is. So it's very important to stay in the market. A real quick note about financial advisors. If you are an investment savvy person, you don't need them. Okay, but you have to be investment savvy. If you're trying to play the stock market, I don't know. Uh, if you have a busy life, like Dr. Rakesh, I was talking to him other day, and he's in ER fixing up patients. He doesn't have a time to do research on individual stocks or even figure out the ins and out of the thing. Though he has, generously allocated his time and effort in us learning this thing. By the way, I want to thank Dr. Rakesh for putting the time with me testing. We went through a couple of dry runs. We went through some technical difficulties on Zoom. We tried so many things. We spent hours. So if this rest of this thing goes successful, kudos to Rakesh for helping me and putting together all this whole presentation. But busy people don't have time to do these things, right? So maybe you should have a financial advisor. It is better to have financial advisor than you saying not investing, right? I'd rather pay somebody than not invest money. Um, you should do it because just like car mechanic or a doctor or a lawyer, you don't know the subject. You should do it because you know very little about investment. You should hire an advisor if you, want somebody to manage it completely for you. I personally use Fidelity Advisory Services, but that's because it's free for me because I work for us for a long time and retired from them. Um, so index fund versus mutual fund. This is I want to go over this very briefly. I highly recommend you look at the the cost of mutual funds. Pay attention to the expense ratios. Uh, the better option for most people is not mutual funds, but it is rather index funds. So let's just understand what's the difference. So John Bogle, that gentleman expired a couple of years ago, he was the founder of Vanguard Group and the pioneer of first index fund. His philosophy can be summarized in these 3 bullet points. Owning the entire market rather than trying to beat it. Okay. Index funds minimize cost. Buy the haystack instead of trying to find a needle like Amazon, Nvidia, AI. By the way, that reminds me, you after you get comfortable, so young people go full-fledged on this thing. Even mature people who are in 50s, 60s, do index funds. If you have extra cash on the side, do play with these stocks because Amazon, Nvidia, those guys were early in the internet days, right? The next wave is AI. There is no denying that. If you can find the next Amazon or Nvidia off an AI, like you would do the same as what these companies have done. So John Bogle's advice was that focus on things you control, which is cost, diversification, and discipline. Right? That's the thing that is under your control. And let the power of market long-term growth work for you because you don't control the market. You do not have a control on what happens to the stock, how they are managed, right? Those are the things we don't control. So think of the cost of mutual funds. Remember how I talked about the compounding over 30 years and how it grows. Well, guess what? The cost of these fees is exactly the reverse, but you are paying it, right? So the fees adds up in hundreds of thousands of dollars as your portfolio grows because they charge you by the way your portfolio, some 1% of your portfolio. When these adds up, when your portfolio is a couple of $1 million, you're paying them huge amount of money. And you're paying them whether the market goes up or down, whether you made the money that quarter or whether that year or not, you're still paying them. That's why the index funds are better. This is just a little chart. As you can see, the QQQ is most expensive, even though it's an ETF. It's, as you can see, it's pretty expensive. Vanguard, Schwab, Fidelity, they all have equivalent number of these. So I'm not recommending any particular one or not even these guys, but these are some examples. Um, so, so let's say you became successful, right? You're in your 60s. You followed this advice. You made a couple of $1 million. Uh, so what do you do now, right? So remember, all this time we kept talking about invest, be frugal, all this stuff, right? But now you're in your 60s. You have a couple of $1 million. What should you be doing now? So this is a little video. Charlie Munger said it. I'm not going to run the whole thing. It's a long video, but I want you to hear a couple of minutes.
5 to 150
Sorry,
is
it's the
considered average in
commercial.
the US. And people internalize.
All right, ready?
I know someone who died at 73 with $2.4 million in the bank, lived in the same small house for 40 years, drove a 15-year-old car, clipped coupons until the end. He'd saved religiously his entire life, never took the big trip, never upgraded anything, never helped his grandkids with college, just kept saving. His kids split the money and immediately bought bigger houses and new cars. Spent in 5 years what took him 50 to accumulate. I've seen this pattern dozens of times now. People who spent their whole lives being disciplined, being careful, building wealth, and then they just keep doing it. Even when the math changes, even when the logic reverses, they save right up until they die. And I keep thinking, what exactly were they saving for? Here's what nobody wants to tell you about money after 60. The rules change completely. The discipline that built your wealth can become the thing that wastes it. Not because saving is suddenly bad, but because the game is different now, and most people are still playing by the old rules. Let me explain what I mean. When you're young, saving is everything. Compound interest needs time. The longer your money compounds, the more powerful it becomes. Save $10,000 at age 25. Let it compound at 10% annually, and by 65 you have $452,000. Save that same $10,000 at age 55, and by 65 you have $26,000. The math is brutal. Time is everything. So we tell young people, save. Save early. Save aggressively. And they should. That advice is correct. But then something happens. People internalize this so deeply that they never stop. They hit 60, 65, 70, and they're still in accumulation mode, still clipping coupons, still avoiding spending, still growing the pile. I've watched people in their 70 seconds obsess over getting 0.2% more interest on their savings account. People with multiple millions arguing with their broker about a $50 fee. The discipline became a reflex, and reflexes don't know when to quit. Here's the question nobody asks. What's the point of compound interest when you have 15 years left? If you're 65 with $1 million and you save another $50,000 and it grows at 7%, by the time you're 80, that $50,000 becomes maybe $120,000. Congratulations. You'll be very wealthy at 80, except you gave up 15 years of experiences
comfort and freedom to get there. And there's a reasonable chance you won't make it to 80. Or if you do, you won't be healthy enough to enjoy it. This is
Right. So this is the message, which is right, that if you successfully got this far and made money, use some of it, because the time what we have left on this planet is limited. There is nothing we can do about that part, right? So, um, yeah, that's it's important. One should. Sorry, I did not switch my screen over for you guys. There you go. So yeah, we have to start distributing some of it to charity, to the kids. If you have stocks, it's better to give the stocks out so you don't have a capital gains, because you give it to charity, it's a tax free, right? So that's a good lesson from him. I have a bunch of lessons, but I think I'm going to, well, I want to cover this slide and then I'm going to stop for questions because we have pretty much hit the 1 hour mark. Um, this is my personal take. You need to put a label on your money. Okay. If you need the money for next 6 months, don't put it in stock market. It should be in a cash, CD, high yield savings account. If you're saying for kid education, you have 10, 15 years, definitely take some more risk, index fund, mutual funds. And also, by the way, know that there are target funds. There are target funds for any number, right? So you can have a target fund that adjusts automatically the risk profile as it gets closer, becomes conservative. In the earlier years, it's more aggressive, and it automatically does that. And you can do it for retirement, you can do it for your kids' education, and so on, right? Um, in retirement, create streams of income in investment properties, dividend paying stocks. That's one of the things we didn't talk. There's a whole industry for dividend paying stocks. You can do that, reduce the risk and get, by the way, Coca-Cola, Warren Buffett's favorite stock, they pay them millions of dollars to him uh, in the dividend. Also, if you have ever noticed, if you look at the year end, the statements from your brokerage, you make more money every year in dividend and interest than the appreciation in stock price. Now, Amazon doesn't pay dividends, so that's a different story, right? Or stocks like that. But all your other investments, pay attention to what the year at the total year end is dividend and interest. It is amazing how much that accumulates. And when the compounding works on that, that's mind blowing how much that will grow. So pay attention to those numbers. Um, okay. So I said, a market correction. This is my personal take that I said in market corrections, don't try to time it, right? So what do? Right? If you're in retirement and you have a limited fund, there's no extra income coming. So what you have to do is you have to put aside enough cash so that you can withstand the bear market. You can withstand the correction, right? Um, here's the message, the one I highlighted. Would you rather have a 300, 400% return on whatever the money you invested than lose a 25, 30% of that because market do correction in that percentage range, or you stay on a sideline? Take your pick, because if you try to stay on a sideline or time to market, you're not going to get 3, 400% return. Me personally, I would take 3, 400% return and gladly give up 34, 25, 35% of it when the market corrects. And that, by the way, market corrects, you only lose money when you sell it, right? If you stayed with it, that correction didn't apply to you. It only mentally bothers you, but it didn't apply to you. Unless, of course, you had to pull the money, which is why I said that if you are in retirement, have a couple of years of spending money on the side so you don't have to touch your investment while it is in the correction phase, because you want to ride through that correction phase. People lose money because they panic in the bear market. All right. I think this all the two highlighted item. Let me just talk. is that if you're overwhelmed by all investment options, start with index funds, stay in the market, and let compounding do its things. But you must start while you are young. Waiting even 5 years, you saw an example. What happens? This is a quick diagram of my numbers. The yellow ones are managed by Fidelity. They've done pretty amazing job actually. Um, and like Amazon numbers are out of the chart, but that's what they do. And lately they have been stagnating. Like the protected bucket I created, that's my what I call the spending money that makes me survive the market correction. So you can see that they are not returning that much return, but that's okay. That's because that money is meant to be, uh, for uh, uh, correct in market correction. So I don't need it to earn 10, 20, 30%. All right. So we don't need to go through this. These are all the slides. The poem is at the bottom. There is even a explanation of why he picked those lines. It's worth saying it. Thank you, everyone, for your enthusiasm, participation. This is the most important takeaway. Start investing early, stay invested, don't try to time the market. I would say don't even try to buy the stocks, just buy the index ones. And that's it. Thank you. There is a message, the email here, or you guys already know my phone number from WhatsApp groups. To my friends who are not in the travel group, Rakesh has created this amazing community. Join us. We love talking about travel and travel only. We don't talk about finance in that group. This is an exception, but I have learned so much from it every time, and you would be amazed where people travel, where people you will learn so much too. With that, thank you, Rakesh, and I will take questions now.